Let's start in that upper left corner with the abrupt halt. I mentioned that because this is unusual because it started with, obviously, it's a pandemic-oriented downturn. And as a consequence of that, we basically either shut off a certain significant percentage of the economy, or so many people were afraid about engaging in normal economic activity that they ceased doing things that they wouldn't normally do. And as I mentioned, you get an abrupt halt. It was the equivalent of slamming on the economic brakes. And that's not normally how we go into a downturn. Usually the data starts to falter a little bit, then it might accelerate, then it really intensifies and we find ourselves in a recession. We don't normally go from the economy is humming along and then we just cease almost everything that we're doing. So that is highly unusual relative to what the end of expansions normally look like. As a consequence of that, it is producing a lot of unusual data. When this first started to happen, because it was such an abrupt halt, you could almost draw a line in the economy between sort of pre-pandemic and post-pandemic. What happened initially was we were getting data that was just unrealistic. It was reflecting an economy that didn't exist any longer. So we were seeing data coming out of the fourth quarter of last year and the beginning of this year that just, it wasn't relevant anymore. It was stale. It wasn't really useful. And since then, we've got data that I would classify as being overly severe. And if you've even been paying remote attention to what's been going on, you don't need me to tell you that it's been overly severe. And I don't think we're out of the woods on this yet. I think probably through the end of this quarter, I would expect to see data that looks overly severe as I'm categorizing it. And I'm not saying that to scaremonger or rile people up. I think quite the contrary. I think it's what we should be expecting given how abrupt we have halted economic activity. I think it's kind of par for the course at this point. So I don't think we should be shocked by it. I think if anything, we should just understand it within the context of how different this is, and then we can move forward from there. Thinking about moving forward from there brings me to what I am calling questionable forecast reliability. The way I describe my job to people who don't do economic forecasting for a living is that during the best of times, during benign economic times, it's the equivalent of throwing mathematical darts at a board. Right now, it's like trying to throw darts at a board in the dark, wearing a blindfold in a smoke-filled room with one arm tied behind my back, and I don't know, the rock is holding my other arm back, trying to keep me from even throwing a dart. So I'll talk about all of the challenges that I face doing that and how I have been approaching that. As a consequence of all of this stuff going on, the government has stepped in and implemented what I would characterize as unprecedented government policy, both in terms of the Federal Reserve and monetary and banking policy, and then in terms of the federal government on the fiscal policy side. And I don't know if you like government, you don't like government, but I think it's hard to argue that the government hasn't stepped in a significant way, given the serious nature of all of this. So I don't take sides on the whole pro-anti-government argument, except to say, objectively, it's hard to look at the policies they've implemented and not think that they have been helpful. I think you really have to take a kind of slanted point of view to think the government hasn't been helpful in this. And then lastly, kind of hearkening back to where I started with this, the pandemic to an extent is going to dictate this downturn, which is something that I will incorporate when I talk about forecasting. It's how we got into this, it's how we are ultimately going to get out of this. And so there's a lot of, it sounds like Donald Rumsfeld, there are a lot of known unknowns surrounding this that we're going to have to contend with. So I'll talk about how I've generally been handling that. Here is a good way to think about how we got into this mess and how we're going to get out of it. Start over on the far left. This started with the health crisis. It started with a pandemic that was increasing exponentially, and we were worried about it increasing to the point where the healthcare system was no longer going to be able to cope with it. So as a consequence of that, what happened is what I'm calling the political state of play. Government officials around the country, around the world, in fact, stepped in to either shut down or lock down certain parts of the economy because they were worried that if we kept going about our typical daily lives, we were going to cause this health crisis to really spiral out of control. As a consequence of those two things together, it is impacting what I'm calling human behavior. And by that, I mean more than just consumer behavior. How we work, how we live, how we play, how we go about our daily lives. You don't need me to tell you that these things have obviously been disrupted, but it's really because either we're concerned about getting sick, or the government is mandating that we can't do certain things, or at least we can't do certain things the way that we used to. All of those things together are obviously having a pronounced impact on the economy, which I will talk about. And then I'll talk about a little bit later in the presentation, the impact it's potentially having on commercial real estate and why I think that might actually be a good thing for our part of the world. If you go back to kind of the left side of this, you can see where the government policy response is trying to intervene. Obviously on the health crisis, it's trying to keep it from getting out of control. I think they're taking objective measures to step in to try to stymie that. The political state of play, clearly they are the ones making decisions about what we can and can't do. So they've clearly been altering that. And then in human behavior, not just in terms of saying what we can and cannot do, but also giving us guidance in terms of how we should go about doing certain things, right? What are the precautions we should take? How should we be careful, respectful, not just for ourselves, but for those around us? That is important because, as I mentioned, this transmission mechanism, how we got into this is how we're going to get out of this. As the health crisis starts to abate, and it certainly has, certainly around here it has. I can't speak for every part of the country, but around here we've clearly seen an improvement in that. We're starting to see the political state of play change. You're starting to see different businesses reopen again, even with certain strictures in place. They are starting to actually, sort of the proverbial green shoots, hope springs eternal. We're starting to see more of the economy opening up again. It's changing the way that we can go about living our lives, the things that we can and cannot do. And that will obviously have an impact on the economy. So the negative transmission mechanism that got us into this can easily become a positive transmission mechanism that can get us out of this. The one thing that I would caution, if you look at the bottom of this slide, we have to be careful about the possibility of a negative feedback loop. The idea that our behaviors either cause the health crisis to reignite and cause problems, or before it gets to that point, cause government officials to step in and say, you know what, we tried this, it's not working out, people aren't following the guidelines, we need to start shutting down parts of the economy again. Because if we get into a negative feedback loop like that, it is going to be difficult, if not impossible, to get the economy to actually start to recover and grow again. So keep your fingers crossed on that. Here's one example of that severe data. I don't want to belabor anybody with this, but I just wanted to show one example of this, how we have seen unprecedentedly high unemployment rates, or at least we haven't seen unemployment rates like this in a really long time. As far as the official unemployment rate goes, which was created by the Bureau of Labor Services back in 1948, these are the highest readings we've ever gotten. There are estimates dating back to the Great Depression that might be higher than this, but as far as the technical reading goes, this is, at least last month, April's reading was the highest that we've ever seen. In May, it came down slightly, but you can see we are still dealing with elevated levels. So if you were thinking, wow, this is different this time around, this is a little bit out of character, how the economy normally behaves, this is probably my exhibit A for this. Whether we could sit and criticize this metric all day long, but I think given that it's been consistently produced over time, it is a pretty good benchmark, at least to say, yeah, we are seeing some really unusual data points, some overly severe data. So this is my exhibit A for that. And again, I don't want to belabor this, but just to show you the magnitude of how different it is this time, we are really dealing with a severity that we haven't seen in quite some time. Brings me to my other talking point about questionable forecast reliability. And this is maybe the best way that I can demonstrate this to you. What I'm showing you on this slide is the range in the consensus forecasts for 2020 real US GDP growth. So what I'm showing is the difference between the most optimistic forecast for 2020 versus the most pessimistic forecast. And I'm showing it to you over time to show you how the world has changed. If you start on the left and you go back to December, the difference between the highest forecast and the lowest forecast was only about 80 basis points. As we rolled through January into February into March, you could see it stayed within a relatively narrow range, 80, 90, 100 basis points. That's not all that much of a difference for something that gets as complicated as economic forecasts. But then you can see what happens when we get to April and May. Not only do the growth forecasts downshift dramatically, but that range really widens out from about 100 basis points to about 720 basis points in April, and then about 560 basis points in May. And it's not as if economists got stupid between March and April. These are very well-educated, intelligent, sophisticated professionals who are using world-class, cutting-edge modeling techniques. The problem is we all have to factor in things that don't normally come up in a typical business cycle. We have to make decisions about what the pandemic looks like in terms of whether or not it reaccelerates and how intense it gets over time. Does it start to come back when there's colder weather in the northern hemisphere in the fall into the winter? How are government officials going to respond to that? What's the policy response going to be? And then how do people respond to that psychologically? Do people feel comfortable about going about their daily lives and re-engaging again? Do they feel somewhat circumspect about it? Do they decide that they're not going to do any of that stuff? So there are a whole slew of factors that we have to take into consideration that we don't normally have to take into consideration during a downturn. This is how I have approached that massive uncertainty. I am not foolish or arrogant enough to think I am somehow superior to all of those other really well-educated, well-trained economists with sophisticated modeling techniques. So I said, you know what? I don't think I could build a massively superior mousetrap, so I'm going to take a different approach to this. And the approach that I took to this is I said, let's just see what the economy looks like on a whole bunch of different possibilities. And I literally did, I will literally say thousands of different simulations of the economy over the next few years, because I had to make assumptions about certain things. I had to make assumptions about the pandemic. I had to make assumptions about government policy response, and I had to make assumptions about how people started to respond to that. So there were literally thousands of permutations and combinations of all of those different factors that I had my models run. And I generally found that it converged around a few generalized cases, right? All of those thousands of trajectories generally started to converge a little bit into what I felt were reasonable cases that I could discuss. And you can see that I've put them on this slide: a base case, an upside case, and a downside case. My point with this slide is not to say we should go through these bullet point by bullet point or give you a really good eye test right now. It's simply to say, these are the general parameters that I had to make assumptions about. What happens with the health policy side, what happens with government response, and then how the economy generally relates to that, how consumers relate to that, how businesses relate to those sorts of things. Let me show you how I've generally been approaching this and what I think are the most important salient features that we're going to have to think about as we work our way forward with this. The first thing you'd see when you look at this slide is you could see the unprecedented severity that I think is coming in the second quarter of this year. And again, I'm not scaremongering about this, but I think irrespective of how you look at the world, if you are kind of optimistic, then that black line at the top is a little more your speed. If you are pessimistic, then something like the gray line at the bottom is a little more your speed. And if you're somewhere in the middle, you're kind of Goldilocks, not too hot, not too cold about where you think things are going, then that red line toward the middle is probably a little bit more for you. I want to make a point about this, though. These trajectories that I'm showing you on this, I don't want you to think of them as specific point estimates. The economy is going to do this in this quarter and this in that quarter and this in the quarter after that. It was impossible for me to show ranges across thousands of different scenarios. So think of these as generalized trajectories for about where I think the economy could go under sort of optimistic, pessimistic, and sort of Goldilocks kind of assumptions about those factors that I was just discussing. So the first important point is look at that second quarter. And I think you've probably heard people prognosticating about this up to this point. I don't think it's hyperbolic to say that there's a really good probability that we are going to get the most severe quarterly contraction in U.S. economic history in the second quarter. I don't think that's, I never say never in economics, but I think that's it's almost a given at this point that the second quarter is going to set a record for severity. And I think irrespective of how you view the world, because to an extent, given the assumptions we have to make, it is a bit in the eye of the beholder right now. I think whether you are on the optimistic side or the pessimistic side, we are in for a very severe contraction this quarter. But look what happens after that. If you look at what happens in the third quarter of this year, all of those trajectories across those three generalized cases, they start to move up again. Obviously, you can see there's a movement, a more pronounced movement upward in the base case and the optimistic case. But even in the pessimistic case, it's a little bit hard to see, but even that line tilts up a little bit. Because even though I think there is pronounced severity in this, there is a great possibility that this is not going to last that long. And I say that for two reasons. Number one, some of this is simply by dint of mathematics. And what I mean by that is we turned so much of the economy off in the first and second quarter of this year that turning almost any meaningful percentage of it back on is almost mathematically going to have to produce growth. So just by mathematics, you're almost guaranteed to see the economy start growing in the third quarter, which is why all of those trajectories start to point up after the second quarter of this year. So that means despite the pronounced severity that we're likely to see, the actual duration of the downturn in the economy is probably not going to be that long. And it's not just the math that makes me think that. I've gone back and I've looked historically at all of the recessions in the United States since the Great Depression, what I would define as the modern era of economics, at least here in the US. And you can see when you look at all of the recessions over the last 100 years or so, the average is about 13 months. It's a little bit longer than 13 months. But if you look closely at this slide, you will notice that there are only 4 of those downturns that actually exceed that average. There's the Great Depression of the late 20s, early 30s. There's the oil crisis recession of the mid-1970s, which I was only alive for part of, but my parents reminded me was thoroughly unpleasant. There is the second Paul Volcker-led recession of the early 1980s. And then there's the Great Recession that we just went through not all that long ago. The thing that all 4 of those downturns have in common that the others do not is they were all financially oriented downturns. There was some massive disruption of the financial system that caused those downturns to be longer than the others. I think we've all heard the stories about the Great Depression in the 20s with massive business failures, the stock market imploding, runs on banks, that sort of thing. So I don't think you need a history lesson on that. The oil crisis recession of the mid-1970s, it started as an oil embargo by OPEC countries as a geopolitical response that had a huge impact on the prices in commodity markets that eventually spilled over into equity markets. It was a severe downturn in the equity markets. I think people who are used to the equity markets in the United States more or less going up since the early 1980s forget that between the 1960s and the 1980s, the equity markets in the United States were more or less flat, which meant if you invested in the equity markets in the 60s, you probably didn't make any money by the 1980s, and the 1970s had a lot to do with that. So that oil crisis recession was actually a prolonged phenomenon. If you look at what happened in the early 1980s, Paul Volcker and the Fed intentionally raised interest rates to significantly high levels to tamp down that lingering inflation that was left from the 1970s. So if you're going to have treasury rates up into the double digits, then you're definitely going to have a disruption to the economy. And then the Great Recession we just went through was obviously centered on the residential real estate market here in the US. I don't think we need to have a rehash of the massive failures that were associated with that. Those were all financially oriented downturns. The other recessions on this slide were not, which is why they only lasted 6, 7, 8, 9 months. Right? They're your more typical post-war recession where the Fed probably raised rates too quickly and tamped down economic activity and caused a bit of a recession. And if you think back to what I said at the beginning of this, the Fed is massively intervening to keep this from becoming a financially oriented downturn. And that contrasts significantly from what we saw just 11, 12 years ago. Remember, that was a credit crisis, right? The idea that nobody was really willing to lend to anybody else because they were afraid about not being able to get their money back. So the credit market seized up, capital availability went down, spreads over treasuries spiked dramatically. This is not that. And again, if anything, the Fed has gone out of their way to keep the financial plumbing operating smoothly, I think to a lot of people's surprise. And I'm not just talking about how the equity markets have behaved, but if you look at the credit markets, if you look at the debt markets, they're pretty much behaving pretty normally under the circumstances. So we do not have a financial component to this. If anything, this is a solvency crisis, right? This is the idea that businesses might not be able to generate enough revenue in order to service their debts. It's not a credit crisis in the sense that they don't have access to capital and nobody's willing to lend because the credit markets are ossifying. It's really a question of, can they actually bring in the revenue to service these debts? So this also gives me confidence to say that this will probably be relatively short in nature, probably not prolonged in terms of the technical contraction, the way that we see during a financially oriented downturn. But that brings me to my last salient feature of this, which is that not all recessions and recoveries are equal, and there's likely to be a long road back after the economy begins expanding. So look at that, the red line at the bottom. That's my kind of base case for the coronavirus recession, or whatever we're going to end up calling this after the fact. You can see there's that severe contraction in the second quarter that I was talking about. There's that technical mathematical expansion in the third quarter as we turn the economy back on. But then notice what happens after that. To get back to where we started, back to that 100 level that I have on this slide, it's a pretty long, tough slog to get back up to there. It takes about 9 or 10 quarters, give or take, at least as far as I can model it out right now, which is a relatively long duration. It kind of looks like what we saw with the Great Recession. Even though the Great Recession's technical contraction period lasted 6 quarters, in order to get back to where we started before the Great Recession, it took more like 11, 12, 13 quarters to get back to that level, which looks more like the trajectory of this recovery. That doesn't look like your typical short, kind of shallow recession in the US. And to show you that, I've also compared this to the S&L recession of the early 1990s and the dot-com recession of the early 2000s. Both of those were relatively short recessions. You could see 2 and 3 quarters each. But notice what happens with those trajectories, right? There's a little bit of a dip, and then they're off and running again. And then we're above, in terms of GDP, where we were before the recession started. So even though I expect this to be short in terms of technical contraction in the economy, I don't think this is going to be a fast turnaround. And the reason that I say that is think about what's likely to happen over the next couple of quarters. And you're starting to see this even here, in New Jersey, but around the country. Stores are opening up again, bars are opening up again, restaurants are opening up again, but they're opening up with some restrictions in place. So let's just pick a number, right? I think I saw something that said that non-essential stores in New Jersey can open up to 50% capacity, right? So let's just use that as our example, as our measuring stick. Let's say that's the case, right? Stores open up again, they're at 50% capacity, and people start shopping again. So it's easy to get that bump from the second to third quarter, but thereafter incremental gains are harder to come by, which is why the slope of that red line flattens out a little bit, because it's not as if we can just say, well, now we'll go to 55% capacity and 60% capacity and 70% capacity, because that's not how a virus behaves, right? The virus doesn't sit there and go, oh, you guys have been good for 6 quarters here, now be at 75% capacity, and I won't be as contagious as I was a few quarters ago. It does not work that way. It's very much a binary thing. And so until we get what I'll call resolution of the pandemic situation, which could be via a vaccine or vaccines, it could be via some remedy that renders this more like the cold or the flu than a potential hospital stay. It could be via herd immunity if more people have this than we actually know. And my guess is it's probably some combination of all of those things, some combination of people getting vaccinated, some combination of medicines that make it not that big a deal for some people, and some combination of a certain percentage of the population that already has it. So even though I expect this to be relatively short in nature, I think it's going to be a pretty tough road back, which doesn't look like your typical short recession. It looks more like a prolonged financially oriented downturn. And just to give you one more point on that, these are within my general trajectories, the paths forward that I think the labor market is likely to take back. And it's really emblematic of those things, right? You can see for at least a few months, I do expect the labor market to come, maybe not roaring back, but a lot of the jobs that we lost, I do expect to come back online. You already saw that in the data last month. We gained back on a net basis 2.5 million jobs that were lost. A lot of those were temporary layoffs, not permanent, so it was relatively easy to turn those back on. And I read a statistic that said about 78% of the people who have been let go have been maintaining a connection, a relationship with their previous employer, which should also make it relatively easy to turn some of those jobs back on. But I don't think we're going to be able to turn all of them back on for the reason that I just mentioned, because we're not opening these businesses back up to 100% capacity, then they're not going to need all of the staff that they once needed. So I do expect there to be this kind of bounce back in the labor market. But then thereafter, as I mentioned, I think the gains get harder to come by. I think there could even be some backsliding later in the year because labor market recoveries often move in fits and starts, that we get some improvement and then there's some backsliding again, and then we get some improvement thereafter. But if there's any good news about this, even though these trajectories are relatively long, in both my upside case and the base case, it doesn't take as long to gain back all of the jobs that were lost as we saw during the Great Recession. We really have to see a downside case to mirror that. So keep your fingers crossed on this. I think the fact that this was a somewhat artificial downturn in the sense that we turned these businesses off for safety precautions, as we start to turn them back on, we can probably rehire faster than we could during a typical downturn. So there's a little bit of silver lining in that sense. And as bad as the jobs data has looked for the last few months, the silver lining is that we can probably turn these jobs back on more quickly than we can during a more typical downturn where the losses tend to be more permanent and not temporary the way that we're really seeing this time around. What does that mean? If I take all of those individual components together and I start to sort of put the puzzle pieces and make them fit, it looks kind of like a hybrid of past recessions, at least as far as I can see in our base case. The downturn is certainly unique in its cause, but it's manifesting itself in ways that look like other recessions. So let me explain what I mean by that. Let's take the technical contraction first. Even in my base case, it looks severe, probably on the magnitude of 9 to 10% peak to trough. That really looks like a pre-war recession. We haven't really seen that kind of downturn in the United States since at least 1945. And the reason for that is, for all of the things that you can criticize about economics and economists, we have really come to develop much more sophisticated management and analysis techniques than we had in the pre-war era. If you go back to the pre-war era, if you look at recessions in the 20s and the 30s and the 40s, you were talking at least high single-digit contractions, probably double-digit contractions, peak to trough in the economy. We haven't really seen that since 1945 because, honestly, we've gotten much better about managing the economy. So we haven't seen this kind of contraction in most people's lifetime. Let's talk about the turnaround in terms of how quickly we see growth start to resume. As I mentioned, I think, keep your fingers crossed, but reasonably, we should start to see growth resuming by the third quarter. And I think the labor market reading last month is making me feel a little bit better about that prognostication. That looks more like your typical non-financial crisis post-war recession, where it lasts 2 or 3 quarters and then growth resumes after that. But then look at the bottom. I elongated that arrow at the bottom to emphasize the point, the recovery. I do think it probably takes more like 9 or 10 quarters, something more along the lines of something like the Great Recession, a more financially oriented downturn that's a little bit prolonged. So when you splice these things together, it's almost like we've created this Frankenstein monster of a recession. It's got individual components that look like other recessions, but none are really consistent. And so this is unusual in that sense. It really is different because we're getting parts of recessions, but we're not getting anything that consistently looks like any kind of recession that we've really seen in the past. So it definitely is different this time around. And if I haven't convinced you of that by this point, this is the last slide I want to show you to really drive this point home. What I'm showing you on this slide is all of the recessions in the United States since 1948. And I picked 1948 because, as I mentioned before, that was the year that the BLS actually created the technical unemployment rate that they've been using consistently since then. On the horizontal axis, I'm showing you the length of the recession in months. And on the vertical axis, I'm showing you the maximum unemployment rate that was attained during each of those recessions. You can see pretty easily that the recessions generally cluster into 2 groups. There's a larger group, which are the shorter, shallower recessions, usually lasting, like I mentioned, 6, 7, 8, 9, 10 months. And they have a maximum unemployment rate kind of high, mid-ish to slightly high single digits, 6, 7, 8%, something like that. Then there's another group, a smaller group, that are the longer, deeper recessions, generally financially oriented in nature. They last into double-digit months, 12, 14, 16 months, somewhere of that magnitude, and they have a higher maximum unemployment rate that goes along with that severity. High single digits to low double digits, 9, 10, 11, 12%, something like that. And then there's this coronavirus recession, which is clearly the outlier relative to all of these other recessions. Even if I'm wrong on my projection for the duration of this, I pegged it at 6 months. I typically forecast quarterly, not monthly, but I pegged it at 6 months just because we've never seen a recession shorter than 6 months in the US. But even if I'm off by a month or two, it's not really going to alter my analysis. And then I'm using last month's reading as the technical unemployment rate reading that for the maximum, because it was 14.7% in April, and then it came down to 13.3% in May. So we've probably past peak. And even if we're not measuring that correctly, because I know there's been some chatter about that, it only would raise that. So it's only making my point more emphatically that this is really an outlier, that when you get these short duration recessions, you don't normally see that kind of severity. But I tend to look at, maybe I'm being a little, I don't think I'm being Pollyannish about this, but I'm certainly looking for the silver lining here. I would reverse that and say, when you normally see recessions of this magnitude, you normally expect them to be prolonged. So if there is any silver lining to come out of this, it's that despite the severity that we're going through right now, it shouldn't last relatively long, and we should be on the road to recovery by the second half of this year. And my guess is by the middle of next year, once we've largely had the health crisis in the rearview mirror, you will start to see growth accelerating again. Thinking about the longer term beyond that acceleration period, what are some of the implications of this? I think the main one that people have been asking about is what are the implications as far as government debt is concerned? Because I think people hear that we're basically printing $3 trillion for the government to go out and spend and plug the hole that was left by consumers and businesses not spending money. Here's how I would address that. Yes, we are going out and spending a lot of money, and yes, it is pushing up our gross debt to GDP ratio. And I would say the way to view this correctly is through the lens of different time periods. In the short term, this isn't that much of an issue. I have no doubt that it's going to push this ratio up as our debt outstanding goes up to pay for all the spending that we're doing and the economy contracts for a little while. You will almost certainly see this ratio go up. Probably by the time all is said and done and the government gets done spending money, probably even higher than I'm even projecting on this slide right now. So in the short run, I think we can play this game because the hole in the economy is it's so daunting, it's so big, and it's like this gaping maw that we just have to fill, because otherwise it would be a tougher slog to get out of this. That downturn probably would be longer. But in the medium to long run, this is a problem, and problems usually arise, and admittedly the economic consensus on this is not airtight, but what I would generally say based on the empirical research is that problems usually arise somewhere around 250% of gross debt to GDP. And to be fair, since for the foreseeable future, the United States will remain the world's global reserve currency, we probably have maybe even up until about 300% on that. But this is not a game of chicken that I think any of us really want to play. I think in the long run, we are probably going to have to address the debt to GDP issue if we start to push close to that, because eventually the Treasury market, I'm going to use a technical economics term here, will vomit all over itself, and it will not like our massive debt spiraling out of control. Interest rates will rise dramatically, and that will really cause another, I know people are probably getting desensitized to this a little bit, but will cause another severe economic contraction that we would generally like to avoid. And I'm not saying I have a magic wand to wave to get our fearless leaders in Washington to fix this, but at some point they're going to have to address this seriously, because everybody is complicit in this. And usually when I talk about this, if I'm presenting in an audience, I can tell who's got some political bent, because they always want to blame the opposite party for this. But as somebody who's very apolitical and objective, I will tell you everybody is complicit in this, because this has been going on, as I'm showing you on the slide, since the 1960s, and you've had Democratic presidents and Republican presidents and Democratic Congresses and Republican Congresses. So I will throw everybody under the bus for this problem. Democrats, Republicans, independents, farm animals, they've all had a chance to fix this over the last 60 years, and nobody is taking this seriously, because they can kick the can down the road to somebody else, and they don't, it's like touching the proverbial third rail. Nobody wants to do it, because a really good way to not get reelected is to tell your constituents exactly what they don't want to hear. So nobody is seriously addressing this issue, which is why it's becoming a problem. But lest you think it's just the government, no. The government is not the only one who is binging at the fountain of debt. Corporations have been doing this for almost just as long, maybe not the same kind of upward trajectory that we've seen with the federal government. There are some ebbs and flows to this cycle, but you could certainly see that on government balance sheet, on corporate balance sheets, they've also been drinking from the fountain of debt as well. I could probably pick on a whole bunch of other segments of the economy, but I think one of the things that has gone somewhat quietly unnoticed over the last 40 years in the United States is that we have all generally been relying on debt much more readily than we once were. And you could say that about consumers. I've certainly shown you it about corporations and the federal government. I could make the same argument about state governments, municipal governments. I think part of the issue is that over the last 40 years, since Volcker and the Fed raised interest rates to such high levels, they've basically only gone in one direction. They've come down. And so it's been a very easy way to finance spending without actually fixing underlying problems, right? It's so much easier to paper over our problems with cheap and plentiful debt than to fix them. So think about what's happened in the economy over the last 40 years. You've had serious structural changes, and manufacturing has it's not that it's declined in terms of productive output, but labor component of manufacturing has gone down, partially because of offshoring, partially because of technology and automation. We haven't really addressed that, right? We haven't really said, well, let's figure out what to do about that hollowing out of the middle class in the United States, instead of saying, hey, we probably need some kind of works program or mentorship program or training program or improving education in a serious way. We've just said, it's sort of like the modern let them eat cake is let them use debt, right? We've let consumers use debt to plug that hole because we haven't seriously addressed the problem. We're letting corporations use debt, and we're certainly letting governments use debt to finance their spending. At some point, if we don't fix that, then all of these other things are just going to keep coming up over and over and over again. So I wish we could have a serious problem about addressing this, but until we address the underlying cause, I don't think it's reasonable to expect any of the massive debt increases that we're seeing in the United States rectify themselves anytime soon. And usually when I bring this up, somebody says, oh, well, that's because it's so expensive to make stuff here in the United States. That's why it's not made here anymore. And usually my retort to that is, there's this far off mystical land you might have heard of called Germany. If you've heard of this magical place called Germany, Germany's unit labor costs are actually more expensive than they are in the United States. Yet Germany is a manufacturing and export powerhouse because they make such good products. Because their labor is so productive, people are willing to pay for those. Goods made by Siemens and Daimler and BMW and these, world-beating champions like that, because the products are really good. There's no reason why we can't do that in the United States. We just haven't had programs in place the way like Germany had. So we have much greater income inequality and wealth inequality than they do, and much greater usage of debt than they do, because they have put programs in place to address that, and we've largely ignored that over the last 40 years. That's not me taking a particular stance on any policy per se, except to say that doing nothing is clearly not a solution to this problem. I do want to make sure that we talk about geopolitical risk before we get out of the woods on this, because geopolitical risk, when I've been presenting on this in the past, the way that I've been talking about it is that geopolitical risk had risen to the highest level that we have seen in decades, probably since the end of the Cold War, the late 80s, early 90s kind of time frame. And I've been talking about this in the past and using a version of this slide. And I was getting ready to present to our big internal meeting that we were supposed to have in March of this year before it got canceled. And I entitled this slide, "Are we in a geopolitical risk recession?" Because usually if I throw the R word around, at least during non-pandemic times, it captures people's attentions and focuses their minds. I'm not sure a geopolitical risk recession is technically a thing, but I was like, well, if I throw that word around, it'll get people's attention. I didn't know that the pandemic was going to get as bad as it was, but I did have an icon on this slide for the pandemic and highlighting it as a risk. I think rightly we've been concerned about the pandemic first and foremost for the last few months, but that doesn't mean that we should have ignored any of this stuff that's going on, because now that we're moving in different stages around the world past the worst of the pandemic, or at least the first stage of it, some of this stuff that we shunted onto the back burner is now getting pulled back onto the front burner, and it's starting to bubble up again. I mean, clearly, there's no shortage of domestic political tension in the country right now. You don't need me to elaborate on that. If anything, it's intensifying. It is not abating. If you think it's just protests in the United States right now, take a look around the world. From Latin America to Asia, people are upset about a whole slew of things. So just pay attention to what's going on in Hong Kong. Pay attention to what's going on in some Latin American countries. People stayed home for a while when it was safer to do that. Now that they're feeling a little bit safer about going out again, people around the world are still not happy about whatever those issues were before the pandemic came about. Brexit is still a thing. They're kicking the can down the road because they haven't fully resolved that yet. If you haven't noticed, the United States and China are on the precipice of another Cold War that is only getting worse over time. I would objectively say our relations are the worst they've been in probably since the late 70s. Probably 40 years or so. And then the last one I want to highlight on this slide is the idea of a vaccine, because I think we clearly are all sitting around rooting for a vaccine, but there are potential geopolitical fissures that could arise around that. Namely, what happens if a vaccine is developed in an unsavory regime somewhere around the world that just decides they're going to basically give it to their people and not share it with anybody else, or they're going to license it out for some kind of exorbitant fee? Or what happens around manufacturing productive capacity, right? The idea that we can go out and produce 6 to 8 billion dosages for people, maybe a multiple of that if we find that it takes 2 dosages, not just 1. How do you decide who gets it if you can only manufacture 300-400 million in a year out of a population of 6, 7, 8 billion? So this has the potential to really foment more unrest if we discover that it's made in some part of the world that decides to borrow an expression like put their country first and then make everybody else wait for it, there are definitely geopolitical issues that could arise around that. So just because geopolitical risk got pushed into the background a little bit, I feel like it is starting to rear its ugly head again. So just keep an eye on that, because the way I describe geopolitical risk is like a wild card. Sometimes if you're playing cards, you pull a wild card, it doesn't have that much of an impact on the hand you have, you end up folding anyway. Sometimes you pull a wild card and all of a sudden it seriously changes the dynamics of the game. This pandemic was a wild card. I don't think we're out of the woods on the wild cards just yet for the next couple of years. So don't lose sight of these issues. I think they're going to be incredibly important. Bringing it back home to New Jersey, as you can see, my general projection for this year, I would expect the hit to the New Jersey area economy to probably be somewhere on par with what we're seeing nationally, maybe even a little more pronounced in New Jersey, just because between New York and New Jersey, we were the main epicenter of the outbreak here in the United States. We did have to lock down more of our economy than a lot of the rest of the country did. And maybe you could argue that some of that is political, but either way, from my point of view as an economist, all that really matters is I do think it will be a pretty serious hit to the economy here this year. But sort of like my overall mantra with this, I don't expect it to be long. I don't expect this to last 2 or 3 years before we start growing again. I think the technical contraction is bad in the first half of this year, the way it's bad in the country, and then I think we start growing in the second half of the year. It's a little bit masked by the fact that I'm showing you annual changes here as opposed to quarterly. But I do think once we get past the severity of this, we will start to grow again. So if you're thinking that the economy around here might take a bigger hit because of the outbreak, I think that's the right way to think about it. But I also think that we shouldn't expect this to be prolonged for the exact same reasons, that you're already seeing businesses opening up again. People are starting to try to go about their daily lives. Some of that will certainly produce growth, even if it's not the kind of gangbusters growth that we would ideally like to see to ultimately pull us out of this. And then the last point I want to make about the economy here, which brings it back to sort of my neck of the economy, which is commercial real estate. I want to more focus on some of the structural factors that I've identified with these different property types, because believe it or not, as challenging as these might be for my industry overall and certain geographies, it might actually really benefit New Jersey. And I say might because I don't think we have enough transparency on this yet, and I don't like making definitive statements until I have better transparency on the data. But let's just move from left to right and just talk about these really quickly. Think about office. The office market in New Jersey, people have thought has been left for dead for the last, 20 or 30 years, as businesses have been generally moving into places like New York City. One of the things that you are seeing now with this pandemic is the idea, not so much that there wants to be this mass exodus out of cities. I don't think that this pandemic is the death knell for cities. I'm usually really cautious about declaring paradigm shifts around events like this because they almost never come to be true. But I wouldn't be surprised if some organizations decide to move out. I wouldn't be surprised if some organizations decide because they need social distancing and they need more space, it's cheaper to find it in the suburbs. So if you're going to increase the square footage per person, office in New Jersey makes more sense cost-wise than it does in New York. Think about how the metro economy around here works. You get people commuting in and out of New York from all over the metro area, including here in New Jersey. I wouldn't be surprised if some organizations go to kind of a hub and spoke type system, which says, okay, we're going to keep our main headquarters or central location in Midtown Manhattan, but we might have satellite offices out in, Bergen County or Morris County or Somerset County, or people commuting, from New York, Rockland County or even parts of Connecticut or out on Long Island. I think some of that will be dictated by where the employee base is commuting from. But I will tell you, just in the plural of anecdote is not data, but we have already been talking to clients who are interested in looking at space and signing leases out in New Jersey in a way that they wouldn't have considered just a quarter or two ago. So even based on the limited data set that I have, we are definitely starting to see indications of that. Industrial, if you've even been remotely paying attention to what's going on in the world, industrial is exploding because of e-commerce sales, and 3PL, if you're not familiar with that expression, is third-party logistics. It just means getting other people to move your stuff around for you. New Jersey has been a major beneficiary of that. Not just big distribution centers down in central New Jersey, 7A, 8A off the turnpike kind of thing, but even closer to home, infill, Secaucus area, places like that, there is no shortage of demand. If anything, the pandemic is exacerbating that demand as people haven't been going into stores and more readily relying on e-commerce to get things delivered to them. So that bodes well for the market around here, although I'm fond of saying it's hard to imagine the industrial market in New Jersey getting any tighter. I think our brokers would tell you that the biggest problem they have is that they're running out of space to lease, not that they don't have space to lease to tenants. Retail, for as much as people have tarred and feathered retail, New Jersey is one of the better markets in the country for retail, because you know what we have a lot of in New Jersey, for whether just a statement of fact, we have a lot of affluent high-income households who go out and spend their discretionary income. So if you're up in Bergen County, I'm sure you know what this is like. Try to go to Garden State Plaza on Saturday, especially because it's closed because of the blue laws on Sunday. You have to park, I think, like 72,000 miles away and take a space shuttle to the mall, because unless you're there when it opens, it's so hard to just find a parking space. The same is true at Short Hills Mall, which is closer to me down here, you know, and a few other good centers around the country, around the state. Retail is more a function of the quality of the center and how well it caters to its customer base than just painting with a broad brush and saying retail is dead. So I've been on record as saying we have one of the tightest retail markets in the country. I don't see anything about this pandemic that'll change that. If anything, if we do get businesses moving in, that should be good for retail sales. Actually, that brings me to the next property type, which is sort of, maybe I could define it as broadly housing, but I'm thinking as sort of multifamily housing. There are already people, sort of like businesses moving out of city centers, talking about moving out of New York into New Jersey. And I think anecdotally, there are a lot of brokers who would tell you that they have showings to people who are looking to move from Brooklyn and Manhattan and even like Hoboken, Jersey City, where they think it's too dense. They're living in some kind of, too dense area, even in those parts of the state. I think that would be a boon, not just for the housing. I mean, everybody knows housing here is expensive, so maybe you don't want more demand relative to the supply. We clearly have a supply issue, but it would certainly be good for rents and values, which I think would also be good for retail. The last one, which is a little trickier, is hotel, because we're not, aside from some parts of the state, we're not quite the major tourist destination that I think city centers are. But if we do get businesses moving out, more like we saw in the 70s and the 80s when we saw the proliferation of suburban campuses in New Jersey, you saw hotel construction build up to support that. Once again, you saw those corporate campuses in Bergen and Morris and Somerset County. Hotels were built to basically satisfy the demand for people who had to go to meetings out in those corporate campuses. At the margin, at least, we might be able to get some reinvigoration of that. So I think commercial real estate could actually be one of the things that helps pull our economy out of this. And I'm not just saying that as somebody who works in this industry and not just an unabashed cheerleader for real estate or New Jersey, although I certainly like living here. I wouldn't stay here if I didn't. But I do think objectively, this could be one of the things that's actually really beneficial to the state as we start to get past the pandemic and recover from this. So just a few takeaways. It's an abrupt slowdown because we got a shock to both demand in terms of people not really wanting to spend money and supply in terms of people not being able to go to work and actually produce things. So that's why you're seeing such a severe contraction. The data is going to seem odd and unsettling for a little while longer. Don't be too freaked out about that. I think we're closer to the end of this unusual data series than we are the beginning of it. I think the duration should be relatively short once we start to see any marginal improvement in the health situation. And to me, that's the silver lining with this, that this isn't going to last forever, that this should end sooner rather than later. And even if growth is not, it's not slam dunk, it's not easy to come by, that we will start to move past this in relatively short order. With that, I will open up to any questions that I couldn't address during our riveting presentation this morning.
Thank you, Ryan. That was completely fascinating. Wow. Yeah. Okay. I'm actually feeling more hopeful than I had been before. So I thank you for that. Like, that's incredible. I didn't think you were going to be able to pull that off. Questions, anybody? We've got Ryan for a few more minutes before he has to go prepare for his second and third presentations of the day.
Yeah, I would like to,
yeah,
first of all, I'd like to thank Ryan very much, because in my personal life, my business life, I have to make a decision. I'm paying office space that's been closed for 4 months. When do I reopen? Do I keep the space, or do I look for a shared space? So the majority of your talk, your lecture, I felt like you were talking directly to me. And I think you've had helped me significantly sort this out in some kind of perspective and form to make a decision. Because I'm by myself, the decision is mine. And I really appreciated what you had to say. Thank you.
No, you're welcome. And the one thing I would say is, again, be wary of people making those grand declarations about paradigm shifts. As far as the office market goes, I think it will be it'll be uncertain for a while, because we're already seeing this. People, my organization included, we're starting to open up offices around the country, but we're doing it slowly and carefully, limiting capacity, one-way walkways around the office space, no more common, kitchenette and coffee area and snacks and things like that. But I don't buy into the idea that offices are going away permanently. If that were the case, it would be hugely detrimental to the economy, because people are more productive in offices because they share ideas, they have those knowledge spillovers, they have conversations. We're social creatures, so we thrive in that kind of bonding environment. If we ever got to a world where we were all just working at home by ourselves, I have no doubt that productivity growth and economic growth would be lower in the economy. Standards would be lower. You would see a lot more trouble, social unrest, things like that. So, and I'm not just saying that as somebody who works in this industry. I just think from a fundamental point of view, it's really hard to buy into the idea that we're past the health crisis and feeling unsafe about this, that we're going to stop going into offices. I don't believe that for 1 second. I think that would be kind of a dim world with poorer growth prospects, where everybody would be so much worse off. They would realize that it's not tenable, because right now people haven't been doing it for a long time, and they're mostly doing it out of health concerns. I think once we do this long enough, people will start to more focus on the negatives than the positives and the necessities, and they'll realize that they do want to be back in an office space with their coworkers, sharing ideas and collaborating again.
Thank you. Other questions? I can't.
Can I ask a question then?
Yeah, please, Courtney. Yeah.
Thank you so much to Ryan. That was really wonderful. My one question for you was, when you're talking about the 6 months of recession following COVID, I'm wondering where you're starting, like the recession point. Like, at what point would you consider the recession starting? And am I understanding that correctly?
So really around February or March, I think the NBER, who are the ultimate arbiters of recessions, just declared it February, because I think in their mind, March got so bad in the latter half of the month that it technically contracted. My research assistant has shown up. It technically was so bad in March that I think they said, okay, February was still a growth mode, but by the time we got to March, the second half was so bad that it was a technical contraction. So I'm guessing somewhere like March to September-ish, give or take. Like I said, I might be off a month or two on the back end, but if we're starting it as February to March, probably sometime September, October-ish, I'm guessing, is when they'll ultimately declare the end of this. But they are the ultimate arbiters of that, and they will not do it until we are months, if not quarters past the end of the technical contraction. So don't expect that declaration to come soon.
Great, thank you.
You're welcome.
Hi to your little friend there.
Yeah. Go ahead, Nevaeh.
I
gotta lock the door.
Could you? No, she's a welcome visitor. Thank you. Also, thank you for that overview. Could you talk about how what is a better gauge of the health of the economy? We see that the stock market is hit 27,000, and very often that is used in the media as a gauge of the health of our economy. And could you either debunk that or support that, or kind of give some background information?
Yeah, I think one of my favorite kind of pithy sound bites about the economy is that the stock market is not the economy. I would much rather look at something like the labor market. I think even relative to a metric like GDP, which is just kind of a massive accounting convention to kind of call balls and strikes on the economy, I think the labor market is a much better indication of what's going on. So I think if you keep your eye on the number of jobs that are being created that we're gaining back, I think if you keep your eye on the unemployment rate, for all the issues that there are about the unemployment rate, especially the broad U6, the unemployment and underemployment rate, I think that'll give you a better sense of what's really going on in the economy. The one thing I'd watch out for a little bit in the short term is wage growth, just because the composition of the employment base is changing so much month to month that wage growth is a somewhat unreliable indicator right now. Basically, you just don't have a consistent sample. So we lost 40 million jobs that were predominantly on in the low wage spectrum of the labor market. So it artificially made wage growth look really good in March and April. Now the reverse is happening. Now you're starting to see those lower wage jobs coming back online. So it looks like wage growth is kind of stalling out a little bit. Neither of those theses are really true. I think you have to get through this kind of weird transition period. So I'd pay a little more attention to the number of jobs being created. It'll probably be inconsistent for a while. I'd pay attention to what's going on with the unemployment rate, and especially the youth unemployment rate, even if that's inconsistent for a while. But that's probably the best, close to real-time gauge that we're going to have for what's going on in the economy right now.
Also, just a follow-up to that is that those minimum wage workers who are both receiving unemployment plus their $600 stimulus are better off financially than they are working at their minimum wage jobs. And so what does that say to some of the future planning motivation for people like aggressively looking for a job to go back to work versus trying to make more demands of basic standard income of what Andrew Yang kind of was running on, but he's not the only one who's talked about that, and that's kind of what we've been forced into, right?
So so what's interesting about that is there's definitely a percentage of the labor force that is earning more because of the extra $600 per week that was passed. Which always brings me back to one of my other sort of pithy laws, beware of unintended consequences. But what I would say is that is going to expire one way or another. Right now it's slated for the end of July. I don't know, given the, increasing tensions in Washington, if they're going to pass legislation to expand that. But what I would say is it's going to end ultimately. And the one thing that I would caution people about being careful about is, it's difficult to pass up an opportunity if you have it, because not just the bird in the hand sort of thing, but if a lot of those businesses are only going to come back online at 50, 60% capacity, and they're not going to hire everyone back, then you are definitely rolling the dice by saying, I'm not going to take a job offer right now because I'm making $600 extra per week. And then you go to find yourself far down in the queue for people to get rehired. And if the businesses only rehire 50 or 60% of those people, and you're not in that first 50 or 60%, it could be difficult for a while to become gainfully employed thereafter. So I'm not taking a stance on what people should or shouldn't do. I'm simply saying it's a calculated risk to sit there and say, I'm not going to take a job until these benefits expire, because it might be a lot harder to gain one back after those benefits are gone than it is during this period where I think certain employers have said on the record that they're having a harder time hiring people back because of the extra benefits. So it's definitely a calculated risk on the part of people that they're just going to have. I don't know how well they're sitting there doing the math at home, but they should probably be thinking about that, because I don't know how quickly all of those jobs get turned back on even once job growth resumes again.
Great. Rodney, did you have a question? And then
well, I kind of had a question. I'm not entirely sure that it's in Ryan's area of expertise. I mean, I've heard a lot about the dynamics of landlord versus renter, particularly in home ownership things. So like local governments providing relief for renters, but that eventually has to get paid back. And then landlords struggling in that dynamic. And there's some dire statements about mass eviction for renters. And I'm just wondering, from an economist perspective, is there any kind of well thought out ideas for helping both sides of that equation? Because they seem to be, if you help one, the other's going to get hurt. And if you help the other one's going to get hurt. And it strikes me as, I just don't know any thoughts or answers. And from an economist perspective, is there a better path forward?
I think what we've generally seen in the industry is that everyone's taking a bit of a wait and see approach about this, relative to what you saw during the last downturn, where I think it was a little more ruthless in terms of, kicking people out of their space and banks, going into technical foreclosure on properties. I think because there's this general understanding, as severe as this is, it will probably be short-lived and we will start to see improvement sooner rather than later. Everyone's taking a little bit of a wait and see approach on this. So landlords are working with tenants to say, look, you have an abatement right now. If you can't pay it, maybe we'll extend the lease on the back end, sort of like a free rent up front kind of phenomenon, and then just extending the lease a little bit. I think you're seeing banks working with borrowers to say, hey, look, we don't want to go into technical default on this and have to take the property back and then have to sell it. That's not really the business that we're in. So we're not going to be so ruthless in terms of you not being able to make the mortgage payment and then be able to, just like not letting you go necessarily, but the understanding that you will make those payments ultimately. So if they have to extend the loan or do some other kind of calculation to adjust that, it seems like they're willing to do that. That's obviously predicated on the idea that this is a shorter rather than longer phenomenon. I think all other things equal, which is a very economist thing to say, the longer this goes on, the harder that game is going to be to play. But I think as long as the economy starts to convalesce over the next couple of quarters, we can probably avoid, the severity that we saw during the last downturn, where you saw more evictions, people just, moving out, and banks foreclosing on borrowers. So to keep my fingers crossed on that, because I think there is a possibility that if this recovery does happen, even somewhat along the lines of what I'm expecting, that I would expect that we could avoid a lot of that the way that we couldn't during the last downturn.
Ryan, I want to thank you so very much for taking the time and walking us through this. And I certainly appreciate your ability to speak very technical stuff in layman's terms. And so, like about to vomit all over themselves, I totally get it. Right. So thank you for that. And
well, you're more than welcome. And when the world does get back to some semblance of what normal was in 2019, which also includes my younger one not Zoom bombing my presentation, maybe we could actually do it in person. I find that the humor definitely works better in person than via technology. But, I'd be more than happy to do that at some point. But if, in the interim, people should feel to, reach out, call, email, smoke signals, send a raven. I got to get in my Game of Thrones jokes before it exits the zeitgeist. But honestly, I'm more than happy to help if I can. So
terrific.
More than free to reach out.
Thank you so much. Take care.
Take care, everyone. Stay safe.
Stay safe.